But forget about the Hunt brothers. The end game is coming. It is coming soon. And this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
The exciting part about this is there is almost no resistance left. And the resistance that is there is extremely weak resistance. It's only technical traders that look at this price and go, well, people, the price might hit this level and then do a pullback. And so I'll sell here and I'll buy here. And a lot of them are going to be wrong because the people that bought back then have either already sold or they're hanging on for far higher prices. There's going to be very few people, and I've said this before, going, at least I broke even, and selling, especially when you account for inflation. They didn't break even. We have to get beyond that $48 price.
The comparison between today's monetary environment and the turbulence of 1980 reveals just how radically different the landscape has become. Back then, the Federal Reserve could raise interest rates into the double digits because the U.S. carried a manageable debt load with debt to GDP near 30%. That gave policymakers room to maneuver, ultimately restoring confidence in the dollar and cooling inflation pressures. Today, however, the same strategy is impossible. With debt levels exceeding 120% of GDP, the Fed cannot hike rates without destabilizing the entire financial system. Instead, they are cutting into rising consumer prices, fueling a cycle of monetary debasement that favors gold and silver far more than in 1980. Rafi Farber, a well-known analyst who focuses on sound money and systemic risk, and MikeMaloney, an educator and precious metals advocate, to unpack why the current environment is far more dangerous for the dollar than anything seen in the past. Their insights highlight how monetary aggregates are no longer being restrained, how inflationary pressures are accelerating despite official narratives, and why gold and silver are positioned to benefit as trust in fiat systems deteriorates. The key difference now is that the dollar does not have the same escape hatch it did 4 decades ago. Policy tools are exhausted, debt loads are unsustainable, and the monetary cycle has reached a point where precious metals could truly break free from artificial suppression. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
But anyway, people tell me, you can't compare to 1980. That's not fair. That's when the Hunt brothers bought all the silver, and that's why silver had $50 because of the Hunt brothers. It had nothing to do with them. Maybe it had 0.5% to do with them. Very, very little. This is one of those things where the mainstream media attaches itself to a certain narrative to hide the fact that the money was collapsing and blame it on two guys who were shipping silver in from Switzerland on airplanes. I'm sure that affected the price somewhat, but the fact is that the dollar was in total freefall and the Fed was in a panic. But the people that criticize me and say, well, you can't compare to 1980. You can't just use 1980 as a metric and then imagine that gold and silver are going to go back to where they were and use all these ratios to say what's the 1980 price in 2025, blah, 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 blah. Well, they're right. They actually have a point. It's not fair to compare to 1980 because this time is going to be a lot worse for the dollar, but better for gold and silver, and better for stackers, and better for the end of the fiat monetary system. 1980 was pretty good for the end of the fiat monetary system, but it wasn't good enough because it kept going, and it's still going today. But this time, it won't, and here's why. What are the main differences between 1980 and now, and why will the dollar necessarily, that's, a relative term. It's not really, but it's not a good term to use in these types of content videos. Why will the dollar probably collapse entirely this time when we reach 1980 conditions when it didn't in 1980? Well, let's go into that. And so here we have a chart with 3 colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up because the U.S. inflation rate, meaning consumer prices were rising. They were rising and rising and rising. And so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, but we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the US inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So, in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why the fiat monetary system did not end in that year. Over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace than they wanted. The monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense. Just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart, when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that. Once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price. But this is, of course, not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension. And then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the US inflation rate, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue US interest rate, the federal funds rate. And you can see here that we're still at above 2.5%, close to 3% in the US inflation consumer price acceleration rate. And the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all.
The situation unfolding today points toward an unavoidable climax in the monetary cycle. Silver's resistance levels are thinning out, leaving little standing in the way of a surge toward much higher valuations. Industrial users, from automakers to tech producers, will soon be forced into defensive buying, stockpiling in anticipation of triple-digit silver. Governments, too, have sounded alarms by classifying it as a strategic mineral, ensuring state-level accumulation alongside private industry. Yet history shows that governments never act without extracting wealth from citizens through both overt taxation and the hidden tax of inflation. At the same time, gold continues to demonstrate its unmatched role as the ultimate store of value, steadily gaining purchasing power against every asset class, from real estate to equities to currency itself. This is the unmistakable pattern of a system in decline, the early stages of hyperinflation echoing past collapses. Let's get back to the interview.
The exciting part about this is there is almost no resistance left. And the resistance that is there is extremely weak resistance. It's only technical traders that look at this price and go, well, people, the price might hit this level and then do a pullback. And so I'll sell here and I'll buy here. And a lot of them are going to be wrong. Because the people that bought back then have either already sold or they're hanging on for far higher prices. There's going to be very few people, and I've said this before, going, at least I broke even, and selling, especially when you account for inflation. They didn't break even. We have to get beyond that $48 price. Well, it means that the government has to start building stockpiles. And so it's another buyer, and it's a big buyer. This is a really big, big buyer. But again, this will also, who else uses silver? Companies like Tesla are going to have to start stockpiling now because they will know that there are higher prices in the future. And so this is very similar. Southwest Airlines got a big, it really helped launch them into a major airline by taking out a whole bunch of oil futures back when oil was like $10 a barrel in 1999, 2000. And so they locked in these prices and they had a huge advantage over all of their competitors. Well, anybody that uses a lot of silver in production of goods needs to take a position now and protect themselves from triple-digit silver and gain that same leverage over their competitors. Yeah, so the countries are the biggest buyers, and you're right, it is more than just the United States. We've put it on the strategic minerals list. But all that was alarm bells for everybody else. It's time. Absolutely true. But the problem with government is they will just tax us more. Silver could go to $1 million an ounce, and they're just going to take as much as they can from the population in two methods: the regular tax and inflation tax. First, we had gold. Then we had gold notes, 100% backed. And then we introduced the Federal Reserve, and it was 40% backed. And then the Bretton Woods, and it dropped eventually to 8%, but there was no specified reserve ratio. But gold standards opened the door for this scam to all happen again. And so I hope we don't end up, I can tell by what countries are doing around the world that we are headed towards some sort of monetary system that has gold connected to it. Is it going to be another gold standard, or will the citizens of planet Earth wake up and say, no, we're going to use something real and that stores value? And fiat currencies have proven that they don't store value, and mathematically they can't. Everybody says, well, this time it's different because. And so this is the because, right? You can't skew and warp the economy forever. What we are doing right, what the Federal Reserve has done, this next bust that we are headed for, which I think is very close. I have a feeling that we are going to have another October crash. I know that what caused this crash was Ben Bernanke changing the way that we create currency in the United States. When he introduced quantitative easing specifically creates a lot of currency that has to get funneled through the markets, through the primary dealers, and it enriches the people that determine their wealth by the size of their stock portfolio, not by their savings or those. That it's at the expense of the average worker that has savings and a checking account and cash in his pocket. That's where it all comes from. And it's the Federal Reserve secretly stealing it and giving it to the wealthiest people on earth. And but you can't warp the economy forever without, if gold just kept on going up at the pace that it's going up forever, which it's still, I believe, fundamentally undervalued. But if it went up at the pace that it's going right now, it's outpacing everything else in gains of absolute purchasing power. If it kept on doing this forever, an ounce of gold would buy the earth. That can't happen. And it doesn't matter if they introduce digital currencies and they put us in this pen and try and extract wealth out of us forever. It cannot happen. It is impossible. This looks like the Weimar hyperinflation. Yeah. Now, if you look at that early part from the end of World War I up until the beginning of 2020, if you make a chart of just that, that is it's a pre-hyperinflation. I remember we were interviewing Jim Rickards, and I was telling him I had discovered this pre-hyperinflation and I was all excited about it. And he goes, "I didn't know I was here for a history lesson." So anyway, that first phase was a conditioning that happened to the population. That loss of 90% of their purchasing power, this is a 90% loss in purchasing power, taught them that if they hold on to currency too long, so the second time that they saw this happening, that's when they started buying anything. A case of doorknobs will hold its purchasing power better than the currency. And so that's what caused that change in public perception and the introduction of fear of holding on to the currency for more than a few seconds caused that endgame hyperinflation. But the point is that gold is going up faster. Every chart looked like this. Real estate looked like this. The stock market looked like this. Everything in Weimar Germany looked like this, except gold was going up at a factor that was greater than all the other things. So it was gaining in purchasing power during this. And it was in my first book. Go back to the Japanese yen chart one more time, the tab before this. Yeah, okay. Go to Japan. This goes back to 2007. And how many times is this? Is gold quadrupled?
At least quintuple.
Quintupled.
At least 5x, maybe 6. I'd have to do some math.
And Japan has been stuck in basically a deflationary environment or stagflation during that whole period of time. Prices of real estate and stuff are not keeping up with gold. If gold quintupled, it's probably tripled or quadrupled in purchasing power of real estate, businesses, and anything else you want to buy. Cars have not quintupled since 2007. So that's a real good measurement. How much is a car since 2007? Has it doubled? Well, that means you can get 2.5 times more cars with your gold. For this year, this has the greatest gains in absolute purchasing power. And that is what matters, is value, not price. And so we're looking at the price. It's up $1,000 this year. But is anything else up 48% this year? Not real estate, not stocks, not Bitcoin, nothing. And so that means that this is gaining in purchasing power against everything else.
The underlying message is that we are standing at the edge of a financial transformation far larger than most investors appreciate. Cycles of credit expansion and currency debasement have been repeated for centuries, but what distinguishes this era is the sheer scale of debt and the speed at which confidence can evaporate in a digital world. Once the illusion of stability is shattered, capital does not wait patiently. It moves instantly toward real stores of value. Gold and silver are not simply commodities in this context. They are the final refuge when paper promises unravel. Every uptick in purchasing power against authentic goods signals that the shift is underway. The structure of the monetary system ensures that once the process accelerates, It feeds on itself until a new standard emerges. Investors who recognize this dynamic early are not speculating. They are preserving purchasing power for the turbulent years ahead. This is why staying informed and prepared matters more than ever. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video.